Most beginner investors think the ultra-rich win by picking secret stocks. But in reality, wealthy investors focus far less on stock picking and far more on how their entire portfolio is structured. They build systems that protect wealth, grow it steadily, and create multiple streams of returns. In this video, we'll break down how the ultra-rich actually structure their investments and how beginners can apply the same principles even with a small portfolio. The key thing to understand is this: the wealthy don't think about single investments. They think about layers of investments working together. Most portfolios at the highest levels are built around three main categories: core asset, growth investments, asymmetric opportunities. Let's break down what each one means. 1. Core assets, the wealth foundation. At the center of most wealthy portfolios are core assets. These are investments designed to protect and steadily grow wealth over long periods of time. Examples often include broad stock market index funds, real estate, large stable companies, dividend-paying investments. The goal here isn't explosive growth. The goal is reliability and compounding. Many ultra-wealthy investors allocate a large portion of their portfolio to these types of assets because they provide long-term stability. For beginner investors, this often means starting with something simple like broad market exposure, rather than trying to pick the next big winner. Think of core assets as the engine of long-term wealth. They may not be exciting day to day, but over decades, they often do most of the heavy lifting. 2. Growth investments, accelerating the portfolio. The second layer is growth investments. These are opportunities that have higher potential returns, but also come with more volatility. Examples might include technology companies, emerging industries, smaller growth-focused businesses, international markets. Wealthy investors often allocate a smaller portion of their portfolio to this category compared to core assets. Why? Because growth investments can deliver strong returns, but they also go through cycles of hype, boom, and correction. By limiting the size of this portion, investors can still benefit from upside without putting their entire portfolio at risk. For beginners, this might mean allocating a portion of your portfolio to higher growth companies or sectors, while keeping the majority in stable core assets. This balance helps capture growth while reducing the emotional pressure of market swings. 3. Asymmetric opportunities, the upside layer. The third layer is something many beginner investors overlook: asymmetric opportunities. An asymmetric investment is one where the potential upside is much larger than the downside. The ultra-rich often allocate a small percentage of their portfolio to opportunities like startup, venture investments, early-stage technologies, private businesses. Most of these opportunities may fail, but the few that succeed can return many times the original investment. Because of this, wealthy investors treat these investments differently. They don't rely on them to build their wealth foundation. Instead, they treat them like optional upside. For beginner investors, the lesson isn't to start funding startups. The lesson is about position sizing. High-risk ideas should usually represent a small portion of a portfolio, not the majority. Why structure matters. Here's the big idea many people miss. The ultra-rich don't rely on one perfect investment. They rely on portfolio structure. Core assets provide stability. Growth investments drive expansion. Asymmetric opportunities create breakthrough gains. Each layer serves a different purpose. When these layers work together, the portfolio becomes more balanced and resilient. Beginner investors often focus on finding the next big stock. But one of the most powerful lessons from wealthy investors is this: how you structure your portfolio matters more than any single investment. Start with a strong foundation. Add growth over time. And only take big risks with a small portion of your portfolio. That simple framework can help you invest with more clarity, discipline, and long-term focus. If you found this helpful, subscribe for more beginner-friendly investing guides. And let me know in the comments which part of portfolio structure surprised you the most.